REITs are often perceived to be boring income investments that are only suitable for retirees. But the reality is very different. The REIT market is vast and versatile with over 1,000 companies worldwide, and there is truly something for everyone. There are REITs like Realty Income that are very attractive for retirees and income investors, but then there are also growth REITs like Prologis that are great for total return-oriented investors, and then finally there are also some very speculative and risky REITs that only make sense for aggressive investors that are seeking significant upside potential. Hey, this is Yoshi. I'm a CFA charter holder but not a financial advisor, so make sure to do your own due diligence. I run a small investment firm that specializes in REIT investing, and in today's video I want to talk to you about two REITs that I think could triple in the near term. Now keep in mind also that these are very speculative REITs. They could also go to zero if things don't turn out well for them. They are very over leveraged, they are at the mercy of their lenders. I'm going to explain all of that to you shortly, but if things turn out well, they could triple or more in the near term, and so overall I still like the risk to reward for very aggressive investors. Before I go into it, I want to remind you that I will soon post a detailed review of Realty Income and everything that's wrong with it, so if you don't want to miss it, make sure to subscribe to the channel. And then secondly, if you could please click the like button, that'll really help me a lot to produce all this content for you. Thank you so much in advance. So the first company I want to discuss here is called Branicks, ticker symbol BRNK. This is a German real estate investment firm that owns its own portfolio, and then it also has an asset management business that earns fee income. Its latest net asset value per share is 21 euros, but its latest share price is just over 1 euro, so the discount to its net asset value is about 95%, and obviously such valuation only would make sense if the market expected it to go bankrupt, because in that scenario no valuation would be low enough, since in the end you will be left with zero. But the flip side of things is that if the company manages to survive, the upside could be significant. It could easily triple in the near term and much more over time. So what are the odds here? Before we answer this question, let's take a step back and review how Branicks got into this situation. So up until the pandemic, the company was actually doing really well. It was rapidly growing its assets under management. This was leading to growing fee income. Its own portfolio was also doing well and rents were rising. And this allowed the company to grow its dividend per share by about 15% per year on average. But then came the first black swan, which was the pandemic. This was a severe crisis for Branicks because it owned mostly office buildings back then, which obviously suffered from the pandemic, as this resulted in significant growth in the remote working trend. And then on top of that, remember that Branicks is also an asset manager, and so it's earning fee income for managing capital for others, but suddenly there were no transactions happening anymore, and so a lot of its transaction fees went missing, and on top of that it wasn't able to grow its assets under management anymore. This then prompted Branicks to make a bold move into the industrial sector, because no one wanted to invest in office buildings, and so it had to rapidly reinvent itself to return to growth. And so with that in mind, Branicks reinvented itself by closing a major acquisition of another listed real estate company called VIB that focused mainly on industrial properties. The acquisition was very risky because it significantly expanded leverage. This was a very big deal for Branicks, but the flip side of things is that if things worked out well, it could be very lucrative for them down the line, because it would allow them to rapidly transform themselves from a fairly small REIT that specialized in office buildings into a much better diversified asset manager with mostly industrial exposure. To close this big acquisition, Branicks had to take a lot of short-term debt, and the plan was then to sell some of these properties to repay the debt. But unfortunately then, shortly after they closed this deal, came the second black swan. Inflation took off. This led to a historic surge in interest rates shortly after they had taken much more leverage. And making matters even worse, then came the third black swan, which was Russia's invasion of Ukraine, which started the biggest war on the European continent since the Second World War. It stopped all transaction activity, and so suddenly it became impossible for Branicks to sell properties to pay off debt, which was its initial plan. Since then, Branicks has made some progress selling assets to raise equity and pay off debt, but not enough to manage all of its debt maturities. This year alone, the company has about 550 million of debt maturities. Most of this is coming due already on the 31st of July, and yet the company doesn't have enough cash. It's not even close to it. Moreover, the company is also very close to breaching some of its debt covenants, and so the risk of bankruptcy here is very significant. Just recently, Branicks announced that it had entered into negotiations negotiations with its lenders in order to extend some of its debt to give it more time to sell assets and pay off debt. And so if its lenders accept to extend the debt, this could possibly give them just enough breathing room to survive this crisis. But on the flip side, if they refuse, this could push the company into default already in the near term. So what are the probabilities here? And obviously the risk of bankruptcy is high, as I said earlier, but I continue to think that the probability of survival is greater than what is implied by Branicks' current valuation, and there are 8 reasons for this. The first reason that's giving me some hope is that this is mostly a liquidity issue rather than a solvency issue. Branicks owns great assets, their rents are growing, they grew by 7% last year, its total assets under management are near all-time high, so its asset management business is also doing fairly well. However, it simply doesn't have enough cash to handle its debt maturities. Last year it generated about 50 million worth of cash flow in what was a challenging year with limited transaction fees, so in a typical year the company has enough cash flow to pay its interest expense, its salaries and all other operational expenses, so again this is more of a liquidity issue rather than a solvency problem. And so this should increase the likelihood that the lenders will be willing to extend the debt by about 6 to 12 months because Branicks is earning significant cash flow, it's retaining all of it to organically pay off debt, it simply needs more time. It's not as if the company was losing significant money and the assets were getting drained by the management into salaries and so on. In that scenario, obviously the lenders will want to get this done as quickly as possible, but the company is not facing such distress yet. The second reason why I think that there's still hope for Branicks is that they have made some progress in selling assets, and so despite not having made enough of it, it's still a sign of hope for the lenders as well. Last year they sold nearly 300 million worth of assets, and that was a very tough year with limited transaction activity in Germany because, again, of the war in Ukraine and the surge in interest rates, the high inflation. If now things get better and they can start selling more assets, this should be very encouraging for the lenders. The third reason is that they have now finally fully suspended their dividend, which will allow them to retain significant cash flow to organically pay off some of this debt, and so this should also help them. The fourth reason is that Branicks has already paid off some of the debt that was coming due this year. Last year it paid off about 200 million of its bridge loan, which is expiring in July. And so while this is not enough progress, once again I think that this is, a clear sign to the lenders that Branicks is doing its best and working towards the repayment of the loans. The fifth reason why I think that Branicks may manage to survive here is simply that the lenders may be reluctant to force a default since they may not have the operational capabilities to manage all of these assets. The legendary real estate investor Barry Sternlicht, who is the president of Starwood Capital, one of the biggest private equity real estate investment firms in the world, recently made a very interesting remark concerning this topic. Here's what he said. We were going to give back an office building and the bank said, well, not so fast. If you want, we're going to restructure the loan. We will cut the loan in half and you will put the money in here and we will take this as a junior note because the banks don't want the asset back. They are not set up to carry these assets. Then they have to go hire someone, do the leasing themselves. It's not their business. They would rather have a GP hold the assets and try to work it out. Right now, we are in an unusual situation in the real estate market because everyone is sort of looking at the yield curve and it says that rates will be lower later. Everyone says survive till 2025, hold on to your assets and sell later. And so I think that this is very relevant to Branicks because, again, the lenders may not be prepared to start managing these assets, and so this should really be a last resort option for them. The sixth reason, which we mentioned now earlier already, is that interest rates are expected to go lower in the near term, and this should help Branicks in several ways. On one hand, its interest expense is going to go down, so its cash flow is going to go up. And then secondly, it's also going to lead to a recovery in the transaction market, which is going to make it easier for Branicks to sell more properties to repay debt. The seventh reason is that there's been quite a few insider buys over the past years, and the most recent one was the COO of the company who made a purchase back in November 2023, so that's not very long ago, and so it shows you that the insiders still have some hope in their ability to avoid a bankruptcy. And then the eighth reason that's still giving me some hope is the fact that the company changed its name less than a year ago. It went from Dick Asset to Branicks. They changed their name because, as I said earlier, they used to invest mostly in office buildings. That's what the market knows Dick Asset for. Now they mostly invest in industrial properties, so they wanted a new name to reinvent themselves. But this led me to ask myself, why would they change their name before bankruptcy? Typically, if you expect to go bankrupt, you would rather change your name after it to have investors hopefully forget some of this bad background that you have. The fact that they just recently now changed their name is encouraging to me. Then on top of that, the commentary of the management has been quite optimistic. If you listen to them, they don't expect to have any issues with the covenants. They also think that it's quite likely that the lenders will be willing to work with them and extend the debt. But again, they've been wrong before, so you need to take this with a grain of salt. The bottom line here is that the company was the victim of several black swans. The first one was the pandemic, then the surge in interest rates, Russia's attack on Ukraine, which stopped all transaction activity in Germany. And so this has put them now at the mercy of lenders. They are currently priced at a 95% discount to the net asset value. So if there is any positive news concerning a potential extension of the debt maturities, I think that this could rapidly lead to a doubling or even tripling of the share price, and potentially much more down the line if they then sell assets and manage to repay some of their debt. But the flip side of things obviously is that it could go down to zero if they don't extend the debt. This is a very possible outcome. So if you're going to invest in a company like Branicks, you need to be comfortable with the idea that you may lose your entire investment. Then the second REIT I want to discuss here is called Industrial Logistics Properties Trust. Its ticker symbol is ILPT. This is an industrial REIT that owns a lot of very attractive properties in Hawaii. Most of its tenants are investment grade rated. It has long leases. Its rents are below market. There's really a lot to like about its portfolio. But unfortunately for the REIT, it made a similar mistakes as Branicks by acquiring another REIT called MNR Real Estate. It's actually a REIT we used to own, so we profited on this transaction. But they acquired this REIT back in 2022 at a large premium. They took on a lot of debt to close this acquisition. A lot of this debt had short-term maturities, and so now they are faced with a massive maturity wall coming their way in 2024. Just like for Branicks, the plan was to take on these new assets, sell some of them, pay off short-term debt, but this plan was derailed by the surge in interest rates, which made it very difficult to sell assets. This then caused its share price to crash from $30 down to just about $3 today. The discount to NAV is about 80 to 85% according to our estimates, and so if it manages to survive, the upside could be very significant. So what's the most likely outcome here? And this is again quite difficult to answer because there is significant uncertainty on one hand, but there is also a bit of hope. The main thing that's giving us hope is that a lot of those debt maturities that you saw in this chart for 2024 actually have extension options. And here's what the management said on the most recent earnings call. Including extension options, ILPT has no debt maturities until 2027. In March, we intend to exercise our first extension option on the $1.4 billion floating rate loan held by our consolidated joint venture. So this is encouraging, but keep in mind that extension options also have some requirements, and so perhaps they may be in breach of some covenants that we don't know here. It's very difficult to find this information, and so it's not a guarantee that the lenders will let them extend this debt. The management is talking as if it was a done deal, and maybe the likelihood of extension is high here, but keep in mind that this REIT is managed by RMR, which is a manager with a very bad reputation and horrible track record, and so you need to take this with a grain of salt. Moreover, extending debt will likely come with higher interest rates for them, and this is a big problem here because their loan to value is about 70%, and so there's really not much more that they can handle. Fortunately, interest rates are expected to be cut quite significantly in the near term. If you look at the Fed Watch tool, currently it's pricing about 100 basis point lower interest rates within a year from now, so that should really help them a lot. The REIT is also in the process of structuring JVs to raise equity in the private market, which it will then use to reduce some of its debt. Ultimately, I think that the fate of this REIT is now in the hands of the Fed. If they cut interest rates enough in the near term, this might just give them enough breathing room to keep paying off debt organically with their own cash flow and also sell assets in the near term to pay off additional debt. In that scenario, the share price of the company could easily triple in the near term, but on the flip side, if inflation is sticky and the Fed refuses to cut interest rates, it could also be the end for this REIT. So once more, I want to repeat it here that these are very speculative investments. They could really well face bankruptcy and go down to zero. So you need to be prepared to face this reality if things don't work out well for them. But on the flip side, they also present significant upside potential. And so overall, I still like the risk reward of them as small speculative positions in my well-diversified portfolio. Now, if you want to access my entire REIT portfolio, you can join my REIT newsletter, High Yield Landlord, for a 2-week free trial. I'll put a link to it in the description of this video. And otherwise, remember to subscribe to the channel, click the like button if you want to support me. Thank you so much in advance as you have my next one. Bye-bye.